Welcome back. We are now in segment 7.10, and in this segment we will be discussing about DSRA and asset coverage ratio. So in the previous segment we had discussed about DSCR, right? DSCR is debt service coverage ratio, right? DSCR is debt service coverage ratio. It provides the rough figure for the comfort level to the banker, right? So how many times the profit of the company, cash profit that is, covers the repayment obligation of the company, right? We've seen this in the previous segment. So don't confuse this DSCR with DSRA, right? In this segment we are going to discuss about DSRA. So DSRA is debt service retention account. Okay, this is retention account. So what happens is, in project finance, the cash flows are uncertain, right? There's no guarantee that the cash flows will be generated as per the projections of the company. So from bankers' perspective, you need a certain amount of protection, that in case the envisaged cash flows don't materialize, the repayment is not affected, right? Because this is actually DSR is for very big projects. You don't see this in normally term loans. Okay, in normal term loans where you come across in lakhs or even small amount, like even lakhs, not just lakhs, even in crores, up to 5 crores or 10 crores, you don't usually see this as DSRA. DSRA is stipulated by banks in very large projects, right? Projects running to maybe 50 crores or 100 crores, large projects, DSRA is stipulated. So DSRA is only for big projects. So what bankers do is, a separate account is created, right? This account is a retention account, in the sense that the cash flows that the project generates will be going into this DSRA. Okay, so DSRA is a sort of an escrow account. So all this cash flows of the company goes into project, cash flows of the project go into this separate account, and slowly it gets built up. Okay, so to what extent this DSRA is to be built up? So say for example the repayment stipulated by the bank is quarterly repayment. Okay, so the repayment may be some 20 quarterly installments, and each installment is 1 crore. This is the repayment as per the sanction term. So bank might say, please create a DSRA equivalent to two installments. So two quarters installments amounts to 2 into 1, 2 crores. So the company has to create a DSRA, has to maintain a DSRA which has 2 crores at any point of time, right? And this DSRA will not be touched in normal course, neither by the company nor by the banker. The company just bills the amount to 2 crores and it gives it aside. It doesn't operate. This is not a normal operative account. Normal operating account is a CC or a current account where regular funds come in and funds go out. This is a separate account. The company won't touch it, right? It will build the 2 crores and leave it aside. The bankers also normally will not touch it, right? The bankers also normally will not touch it. So when this DSRA comes into picture is, in case the say for example a particular quarter installment could not be met, say December 31st is the due date, but it's Jan 15th or Jan 31st, February, still the company is not paying, and the bankers feel this account is running into, there's a risk of this account turning into NPA. March 15th, so in another 15 days is going to turn into NPA. So when the bankers become very concerned that this account is going to turn NPA, in a very critical case, what they do, they then draw from this DSRA. The bankers are allowed, they have the power to draw from this DSRA. Usually it will be a consortium account. We're speaking of a very large project. Usually a DSRA is for large projects, and large projects finance usually is for consortium account. So I mean, even it could be for a single banker. Usually it's a consortium account. So then in that sort of a critical case, the bankers will draw upon this DSRA. So say for example they'll draw 1 crore. 1 crore goes. So with that they'll be meeting this installment, and the account will not become NPA. Okay. Of course, the DSRA balance will then become 1 crore, obviously, because 1 crore is drawn. Then the bankers will be pursuing with the company to build up the DSRA again to 2 crores. Okay. So the logic basically is, it is again another sort of a comfort to the banker. Right. DSCR is a comfort to a banker, in the sense that it's a comfort to the banker, but at the end of the day, these are projections, right? DSCR is just a calculation. It's a calculation of the projections. It's a calculation based on the projected financials. When I'm saying DSCR is profitability plus depreciation plus term loan interest by installment plus interest, how we are calculating this DSCR? These are all based on projected financials. The numerator PAT, where is it coming from? For the next 5 or 6 years, you're calculating the projected profitability and then arriving at DSCR. So DSCR is high, say 2 or 3. But just because it is high doesn't mean it's a a reality. These are projected financials. Ultimately, this may not materialize, right? And the projected profitability may not be achieved. But DSR is different. DSR is a reality, right? DSCR might actually turn out to be a myth. We don't know, right? The projected financials might be very rosy, right? But when it actually comes to the reality, the company may not achieve the projected finance, projected profitability. So DSR is different. DSR is not a projected figure. It is a reality. So the company will be maintaining a real account. It's a true account. It's a reality. DSR is a true account maintained by the company. This provides a real comfort to the bankers, because in case the company could not meet the repayment obligation, then bankers will be drawing upon this DSR. Okay, so DSR, it is up to the bank to stipulate how much DSR should be. Say for example, it is a monthly installments, bank may say 6 monthly installments or 3 monthly installments or 12. It depends on the riskiness of the cash flows they envisage. Or if it is a quarterly repayment, 2 quarters or 3 quarters, 7. It depends. It's up to the banker. So it's an additional fund, right, to the bankers in the event that the project fails to generate the adequate funds to pay the installments. Okay. So DSR is usually funded after debt service but before distribution to equity. Okay. So when it's released when the DSRA balance is high, right? So say for example, always the company has to maintain 2 crores. In case the balance goes up by 2 crores, maybe then the company might draw. Maybe that will be the agreement. But if it is an inadequate balance, it falls below 2, right, 1.8 or something. The company has to replenish and bring it back to 2. Okay. So what is the relation between we said that DSC, don't confuse DSCR and DSR. They are 2 separate entities. But are they related in some way? Yes. If the DSCR is below 1, right? If there arises a situation where the company is unable to repay the obligations, then DSRA will be drawn upon to bridge this shortfall. Okay. So DSRA is normally not enforced, right? And nobody wants it to be enforced, because neither the banker nor the company. Because when it is enforced, it means the situation of the company is not good. You don't actually want it to occur. Like it's like an insurance policy, right? So there is a insurance policy which covers the life of a policy holder. So if this person dies, you'll get a 10 lakhs. You don't want this person to die. See, just the buffer, right? This is a safety. This is for the safety. You don't want this policy to be enforced. You never want this policy to be ensured, because when this policy will be ensured, only when the person dies. You don't want this, but it's only a safeguard. Similarly, bankers don't want DSRA to be enforced. It's only because if it comes to that extent of enforcing DSRA, it means the account is in a bad shape. You don't want DSRA to be enforced, but it provides a sort of a safety net to the bankers. Okay. One more concept which you need to be aware of in project finance is asset coverage ratio. Okay. It's very commonly calculated metric used in project finance. So it determines a company's ability to cover debt obligations with its assets, right? Very simple formula. It's obtained by dividing the net fixed assets, that is the accumulated depreciation taken off from the gross block, and then you divide by the term loan outstanding. So say for example, these are the financial projections. This is the net block. So you can see it is decreasing because depreciation is being applied. Okay, so term loan outstanding is slowly decreasing because repayments are going to be affected. Slowly it's going to be decreasing. Maybe the company initially borrowed 50 crores and slowly every year it's paying off 10 crores. Okay, so when you calculate asset coverage ratio, this is net fixed assets by term loan outstanding. So it is 2 in the initial years, and then it goes on because the term loan is dropping, right? So even though the fixed assets is coming down, term loan outstanding is dropping at a faster pace than fixed assets. So your asset coverage ratio goes on increasing. So what it tells you is how many times your security, that the primary security, that the fixed assets will cover the term loan outstanding. So in a way it is linked to margin. Because if the margin is less, this term loan outstanding would have been higher. Say for example, in the first year, net fixed assets is 100, but instead of 50, if the bank has sanctioned some 75, then it would have been only 1.33, isn't it? Not 2. So in a way it is linked to the margin. So higher the margin, lower will be the asset coverage ratio. But this is the calculation, right? Basically, it provides a metric to measure how many times the security, that is the fixed assets, will be covering the term loan outstanding. Okay. So with this we come to the end of the segment. In the next segment, that is 7.11, we will be discussing about break-even analysis. Okay. See you then.